asset classes we've been monitoring closely is the local bond market. The 10-year yield now at a 7.5-month low, just above 6%. The 10-year U.S. Treasury yields hover among 3-month lows of late. With us now for more is Mike Ricafort, the Chief Economist at RCBC. Good to have you back, Mike. Welcome to the program.
Good morning, Cathy, interviewers. Nice to be back.
Okay, so it looks like liquidity is prevalent in the system. The 10-year yields have started coming off last week. So what is driving that to 7.5-month lows?
But first, it's the benign inflation, and also it's a global thing. As you mentioned, the 10-year Treasury yield is at 4.20 levels and among the lowest in 3 months. And because also liquidity-wise, there would be a lot of maturity for the 5-year RTB. That's 516 billion come August 12 tomorrow. And 5 years ago, their yield was at a record low of 2.625. If they're going to invest now, the coupon is at 6% with the average auction yield of 5.94. It's more than double. And there's still another maturity by next month, by September. That's a total of 288 billion. So fundamentally, it would increase the liquidity into the financial system. And they'll be looking for a new outlet, a new home, and at a much higher yield, more than double. And they'll be happy with that. Kathy.
Mike, where's all the demand coming from for these RTBs, the retail treasury bonds?
Well, essentially, Kathy, it's from all types of investors up to the retail level, from the institutional ones, both local and foreign, as well as, these are long-term bonds also. Especially the fund managers with who can afford to have these kinds of long-term investments locked in. And the timing is kind of favorable because the yields are still near cycle highs at above 6%. And the fair value of that, if you look at even the averages relative to, say, the U.S. yields relative to inflation and the BSP rate, fair value is around 5%. So there's a downside of almost 100 basis points from a trading perspective. And, the unique thing about fixed income is that, the investors could lock in the yields, whether institutional fund managers, high net worth individuals, even retail investors. They just hold on to it until it matures, and they would kind of somewhat eliminate the market risk, okay? And enjoy the relatively high yield to maturity of close to 6%.
Well, let's take a look at the other metrics here. We've had lower than forecast CPI print. Let's pull up that chart right now. Inflation now hovering at near 6-year lows just before COVID. That's the black line there. When you superimpose that with the local policy rate hovering at 5.25, that's the blue line, you'll see that the gap between inflation and the policy rate continues to widen, now below target for 5 straight months. So what does that tell you now about the Bangko Sentral? Does it have a lot more catching up to do, cutting rates in the back half of this year?
Yes, Kathy. Actually, they have all the leeway. The only thing that's constraining the future rate cuts locally would be the Fed rates because of the healthy interest rate differential that must be maintained. Currently, it's already at the record low at 75 basis points. The BSP rate at 5.25, the Fed rate at 4.5%, and this is our biggest story. I mean, the benign inflation environment, even in the U.S., the odds have increased already that by the next Fed meeting by September 17, a possible quarter point cut by then, and on the next BSP rate setting meeting, as signaled also by some of our local monetary authorities for the past month or two, as early as August 28, possible quarter point cut. So that would bring the interest differential to the tightest on record, 50 basis points, but it would normalize because the Fed would also cut by September 17. So it would be back to 75 basis points, and for the rest of the year, towards the end of the year, there would be another quarter point cut by the Fed. That's based on the Fed futures of pricing in 57 basis points cut, and the Fed dot plot, official estimates of the Fed officials, total of 50 basis points cut this year, and the BSP would also match that. So there would be additional 50 basis points cut by the BSP. So yeah, it's really a matter of managing this interest differential, and just like any other central bank in the world. But going beyond by 2026, 2027, the Fed dot plot is pricing in another 25 basis points cut by 2026, another 25 basis points cut by 2027. So the BSP has all the leeway to match this, and of
Okay.
course, signals also of a further cut in
All right.
reserve requirement ratio by next year.
All right, we'll keep tabs of that. A lot of rate cutting there, potentially really lower rates ahead. Thank you so much, Mike Ricafort of RCBC.